More and more, I see many people putting out content about the impending doom of the stock market. But, rather than not investing and selling out, there are better ways of managing risk to prepare for the eventual market correction. When it comes to investing, it is important to have a long-term outlook. The stock market has proven since inception that it is the best vehicle to grow your wealth. Besides the real estate market, no other investment has given this exceptional growth over a long period of time. But, the stock market is full of significant corrections that happen every few years. Some of those corrections, like the dot-com bubble or the financial crash of 2008, were devastating to those who were close to retirement. But how do you prepare your investment portfolio to withstand the market crashes that will surely come, and at the same time, be able to take advantage of the long-term growth of the stock market? One way is through purchasing put options. Options can be somewhat intimidating to those who are beginners in investing. However, learning the basics on options is enough to help you in managing your investment portfolio to handle the market crashes. One method of hedging against market crashes is called protective put strategy. It is essentially buying downside insurance on your investments. This strategy basically requires you to long the underlying investment, and purchasing some put options against the underlying. For example, if you were to own some Tesla stocks with average cost basis of $1,000 per share, you can purchase put options against those stocks by buying out of the money puts at, say, $900 strike, 3 to 6 months into the future. This essentially implements a 10% downside protection on your Tesla holdings. You can implement the protective put strategy on ETFs and broad market index as well. If the market crashes beyond your put strikes, you will make money on your options, which hedges the loss you're taking on your portfolio. If the market does not crash, you're only out of the premiums paid for those puts. Another method is to sell covered puts and collecting premiums as you wait for the market to dip. It is essentially similar to protective put strategy, except that you will collect premiums on your puts rather than paying for it. If the market drops to your strike price, you will eventually need to purchase the 100 shares times the number of put contracts you sold. So make sure you have enough cash as collateral to buy the shares at those prices. Hence the name, covered puts, where you need cash to purchase stock if the options are exercised. Remember, one option contract is equivalent to 100 shares of stock. If you don't like to play with options, you can always diversify your investment so that you are not wholly exposed to the equity markets. Investments in commodities and real estate are some ways you can diversify your portfolio to hedge the risk of the stock market. You can invest in commodities like gold or oil to help spread your risk. When it comes to real estate, I would recommend going the route of non-public real estate trusts. These real estate investments are not tied to the stock market, thus provide better insulation against market crashes, unlike investing in real estate stocks. As I have mentioned earlier, it is important that you focus on the long-term growth of the stock market. Peter Lynch, one of the best mutual fund managers of our time, once said that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. It means that fear of the impending doom can result in you underperforming the market. Sometimes, it is better to just let the crash happen and prepare to buy the dip. Averaging into your investments have shown to have better results in the long run. Whatever method you choose to manage risk in your investment portfolio, know that the markets will eventually recover. Being invested at all times is going to help you grow your wealth better than playing with your portfolio with short-term predictions. Anyway, that's the end of this video. I hope that you feel more confident about investing in the long run, and not worry too much about the stock market doom and gloom mentality. If you like the content of this video, please hit the like button and subscribe to this channel. Thanks for watching.